Hello, today I'm going to talk about randomness, the noise that looks like signal. So imagine, I'm just making up an example. Imagine if a sales manager came to me with exciting news and says, "Hey Hindol, I figured it out. When our reps are wearing the blue shirts and they go to client meetings, they close 40% more deals. And I have the data to prove it." Okay, all right. So I looked at his data. He had tracked about 30 meetings over 2 months, which is a good thing. And the reps that were wearing blue had indeed crossed more than, had closed more deals. So the question is, what if you flip a coin 30 times and it comes up heads 20 times and tails 10? Would you conclude that the coin is magic? So he paused. That's the thing about randomness. It creates patterns that look meaningful, but they are not. It makes us see causes where there are none. It tricks us into confident decisions based on nothing but noise. And in business, this happens all the time. We celebrate strategies that work by luck, and then we fire people for failures that were random. We build plans on our patterns that might never repeat. I'm Hindol. I've been a CFO in the Valley for 25 years, and today I want to talk about randomness, what it is, and why it is so dangerous when we don't recognize it. So let's get into it. Let's start off with the underlying definition, right? What is randomness? What does it mean? Let me start with a simple definition. Randomness is nothing but variation. It has no predictable pattern and it has no identifiable cause. It's a noise in your data that is not explained by anything systematic. So here's an example. Let's say your average monthly revenue is $100,000 and some months you do $85,000, some months you do $95,000, some months you do $104,000, some months you do $101,000. Well, is that variation considered random? Or might there be a cause associated with it? If December is always high and January is always low, that is not random. That is more seasonality. We discussed that in the seasonality video. There is a pattern. However, if revenue goes up every time you run a marketing campaign, that's not random. That becomes more of a causal relationship. There's an explanation for that. But if some months are high and some months are low for no discernible reason, and it's not tied to seasons, it's not tied to actions you took, it's not tied to anything you can identify, then that has all signs of randomness. And here's the key insight. Randomness is real. It's not a sign that you're missing something. It's not a failure to understand your business. It's some variation that genuinely has no cause. It's just noise. Think about flipping a coin. Each flip is random. If you get heads 5 times in a row, there's no explanation. It just happened. You cannot predict the next flip based on the previous ones. That is pure randomness. So business is not quite like coin flipping. There are real causes and there are real patterns, but there's also genuine randomness layered on top. And separating the signal from the noise is one of the hardest things in forecasting. So why does randomness fool us? And here's the problem. Human brains, they are pattern-seeking machines. We are evolved to find patterns because patterns have helped us survive over the ages. That rustle in the grass might be a predator, but better to see a pattern that isn't there than miss one that is. But in business, this instinct might backfire. We see patterns in random data all the time. And let me give you one classic example. Take any stock chart and look at it. You'll see shapes, trends, momentum. And it looks like there's a lot of information embedded in all those shapes. But decades of research have shown that short-term stock and movements, they're largely random. The patterns you see are mostly illusions. And yet industries exist around technical analysis. They try to find the patterns in randomness. And we're doing the same thing in business. We launch a new product and sales are strong for 2 months. We conclude the product is a hit, but maybe it was just a random variation. Now, month 3 might be weak, and then your entire analysis goes off the trail. So the key element is that understanding randomness is important, but there's not much you can do with randomness and gaining an understanding of it. If we have a bad quarter, we blame the sales team, we make changes, but maybe it was just a random dip. The next quarter might have been fine regardless. So what I'm saying, in other words, is that statisticians call this overfitting, by the way. When you try to find explanations in noise, and that is when all the terrible decisions start happening because you're reacting to randomness. The blue shirt story I started with, remember? That's exactly what that is. The sales manager, they found a pattern in a random data without any causal inferences and was about to build a dress code around it. So let me introduce a framework that has helped me enormously. How do you distinguish the signal versus the noise? Signal is a true underlying pattern. It's a real relationship between cause and effect. If you run a good marketing campaign, revenue goes up. That is a signal. Noise, on the other hand, is a random variation around that signal. Even with a great campaign, some months will be higher and some lower just by chance. And that is noise. So every data point you see is a signal plus the noise combined, and your job is to separate one from the other. So here's a simple example. Say the true relationship is that for every $1,000 you spend on advertising, it generates $5,000 in revenue. Great, that is a signal. But when you actually run the campaigns, you don't exactly get $5,000 every time. Sometimes you might get $4,200, sometimes you might get $6,100, and sometimes you might get $4,800. But the average is around $5,000. That's the expected value. That's a signal. The variation around that average, that is a noise. And now here's where it gets tricky. With small amounts of data, the noise can overwhelm the signal. If you run one campaign and get $6,100 in revenue, you might think advertising returns $6 for every $1 spent. But that's $6,100 included noise. The true signal might be just $5. If you run 100 campaigns and average them, the noise starts to cancel out. Some high, some low, and you get closer to that expected value, that true signal. This is why sample size, it matters so much. With small samples, you are mostly seeing noise. With large samples, the signal is starting to surface. So associated with randomness is variance. Let me introduce another important concept here. Variance is nothing but a measure of how spread out your data is. High variance means that the numbers, they bounce around a lot. Low variance means that they are tightly clustered. And here's a key insight. The higher the variance, the more likely you're going to see patterns that are just randomness. So let me give you two businesses, an example of two businesses. Business A has steady revenue, every month is growing at 5% on average. The variance is quite low. Whereas business B has volatile revenue, some months is 50% above average and some 30% below, high variance. In business A, if you see a 10% increase that is unusual, it is probably a signal something real happened. In business B, however, if you see a 10% increase, then it feels normal, It feels like normal noise. It happens all the time. You cannot conclude anything from it. That is why the high variance businesses are so hard to manage. The signal is kind of buried in the noise. You cannot tell if your strategies are working because normal randomness is bigger than the effects you're trying to measure. So when I work with the high variance businesses, I'm much more cautious about drawing conclusions. I need more data, I need more time, I need more evidence before I believe that a pattern is real, and I'm very careful about overreading into it. A bad month in a high variance business does not mean something is wrong. It might just be noise. So how does randomness even show up in businesses? Where do you see it? So let me give you some common places where randomness creates problems. If you look at sales performance, right? Individual rep results, they vary enormously month to month, often randomly. A rep who crushed it last month might struggle a bit this month. And there's no apparent reason for that, it just is. And if you judge people on short-term results, you are largely judging luck. Marketing campaigns, same example, response rates fluctuate. A campaign that performed well in one campaign might not perform just as well the following campaign. Small tests are especially noisy because you need significant sample sizes to know if something is actually working. Customer acquisition. Some months more customers are signing up and some fewer. Unless you can tie it to specific actions, much of this variation might be more likely than not random. Think about product metrics. Feature adoption rates bounce around all the time. A feature that looks popular in a few weeks ago might look weak a few weeks later. Random fluctuation makes it harder to evaluate quickly. And now let's talk about our world, forecasting. Sometimes you hit your forecast and sometimes you miss. And even if your process is exactly the same, some of that miss is random, so you cannot eliminate it. Deals close, and when they close, some are 3 in one quarter and some maybe 1 in one quarter. Who knows? Again, randomness is raising its ugly head. So, all of these cases that I just explained, the temptation is to find explanations. The temptation is to figure out why this month was different. But sometimes the honest answer is no reason. It's just random. So what are the key takeaways that we can have from this example? Let me wrap it up in three things that you need to remember. Number one, randomness is real variation with no predictable pattern or identifiable cause. It is noise that is layered on top of true signal in your data. Do not assume that every fluctuation has an explanation. Number two, human brains are wired to see patterns even in random data, and this leads us to find causes that don't exist. It leads us to celebrate strategies that just work by plain luck and blame people for random failures, again, based on bad luck. Number three, variance determines how much noise you're really dealing with. High variance situations need more data and more caution before you draw conclusions. Small samples in high variance contexts are mostly showing you randomness. So I'm going to do another video to show you how to actually detect randomness. The tools and tests that help you know whether you're looking at signal or you're looking at noise. So thank you for watching this. This was a brief introduction to randomness. We're going to talk about randomness and signal again in our following video session. Take care. I'll see you soon. Bye.